Good afternoon, everyone. Pleasure to be here. We are going to speak today at the EIC Summit about corporate venture capital as a new investment trend in Europe. And I have the honor to be on the same panel today with three people who are going to introduce themselves now and talk about their companies, their corporate venture capital funds, and as well their startups, to let you know about their focus areas and about their strategies. So if I could start perhaps with Geert. Could you, Geert, just say a few words about yourself and Shell?
Does this work? Does it work now? Okay, good. So my name is Geert van der Wouw. I'm the head of Shell Ventures, which is a corporate venture capital arm of Shell. We've been in corporate venture capital since 1996. We invest from 7 locations in the world, in the US, in Asia Pacific, and Europe. We have a portfolio of about 100 companies, and we just set up a new $1.4 billion fund to invest in climate tech, renewable energy, and mobility and transportation.
Perfect. Welcome, Geert. And Suzanna.
Hi, everyone. My name is Suzanna Chiu, head of Amadeus Ventures. So I run the startup investment program for Amadeus IT Group. So we are a technology company in the travel and transportation industry, headquartered in Spain, but with also a big site in France and Germany. So with our investment program, our focus is to find and work with startups that are at the crossroad of travel and technology.
Perfect. Welcome, Suzanna. And now over to the other side, the startup side, Carlos.
Hello, this is Carlos Rodriguez Villa, the managing director of the company AlgaEnergy. We are a Madrid-based company with subsidiaries in 11 countries, from the US to Mexico, Brazil, Australia, Japan. Throughout the development of the company, we've had different partners at the investment level. Some of them have been corporate venture firms like Repsol, Iberdrola in the past, and today we have also a Japanese company called Yokogawa and Caixa Capital Risk also as shareholders of the company. Our focus is to work with microalgae to produce sustainable products that can replace chemicals and increase yields, for example, in agriculture, but also in some other applications.
Brilliant. Welcome, Carlos. And just a few words about me. I'm here also on behalf of EIC Fund. An EIC Fund, where I'm an investment committee member, is a part of the European Innovation Council that invests in equity in startups and scale-ups. And companies like Carlos's are perfect startups that EIC Fund can invest in. But to do that, we need co-investors. We actually need them to lead investment projects, and this is why the relationship with the corporate venture capital sector is so important for EIC Fund, because what we do is we invest together. EIC Fund is a new entity. It was set up last year and has now reviewed and signed the vast majority of the first 160 projects, investment projects, equity investment projects, right across the European Union and associated countries. This year, we are continuing strongly with the equity investments. The investment tickets are between 500,000 euro and 15 million euro, but the round sizes can also be bigger, and we can just be one of the investors in those rounds. EIC Fund will not invest more than 50% of the round, so it's super important to have the lead investor from the market work together, and it is the market that sets the investment terms. So it's a pleasure to be here on this panel today and talk a little bit about how to work with corporates. We know that there are many benefits from having a corporate investor inside the company. And I thought maybe we could start with the startup view on how you have benefited from your corporate relationships, from your investors.
Sure. It's no secret to anyone that when corporates do an investment, they look normally for more than just a financial return. They look for, and you can now double check this, but they look for enabling technologies, driving technologies, synergies that can grow current or future business. No? And in our case, we have had two companies that were very much related to one of the verticals, which is energy. And that has benefited us from different points of view. One is very clearly the reputation side. No? When you have a corporate entering into a company, it's a stamp of validation of a technology. Normally the corporate knows much better than anybody else what are the market trends, where are the things going, what is interesting to be in, to take a strategic step into. No? So from a reputation side, this has been always very helpful. It opens a lot of doors. And then also from a strategic point of view, it creates synergies, and particularly now with Yokogawa, this Japanese company that specializes in industrial automation. We have not only them as shareholders, but also as scientific partners. No? We have a scientific committee that meets every month. We interact with 20 different people in Japan, in India, in the United States, and we look at a plan where we can exploit to the mutual benefit the synergies we have between the companies on a short term, on a longer term perspective. And already today we have integrated technologies from Yokogawa in our production facilities, and this has been really interesting. We consider it a competitive advantage compared to other companies that may be active in the same space.
Brilliant. And from the point of view of the corporate venture capital, how do you see you benefit with the relationship with the startups and those investments you have made? Could you talk a little bit about that, Suzanna?
Sure, I can go first. From a corporate perspective, like being an investment program, on the one hand, we are aligned on the financial incentive side to say like, we want the company to do well, and we support them in pursuing growth opportunities by providing with the funding. But on top of the funding, it is also about our network of customers, like our technology and the expertise that we can share. And overall, so what we would like the startup to be able to do is to work with us as a corporation to be able to bring new value propositions together with our solutions to our customers, to be able to like bring new technologies into the travel and transportation industry, or to just together create new value propositions together in a much faster way. So in a way, building an ecosystem of innovative partners around like some core capabilities that we have already provided and enabled airlines and hotels and travel agencies around the world.
And Geert, how is it important for Shell? What do you see as the benefit from the corporate side to work with fast-moving startups?
Yeah, so, you know, if I make a 5x return on a $10 million investment, to be honest, nobody in Shell wakes up for that, right? It's just besides the comma. Where we really make money from working with startups is where we can get these startups to work with Shell businesses and scale their technologies to a size that matters in the energy industry. So, for example, we've used a digital twin technology to look at wind turbines in the North Sea and optimize the design of these turbines and reduce cost with 10-20%. That's where the real impact is. Now, that all sounds great, but it's actually really hard to get these startups work with large corporates. And so you really have to put a bespoke program in place to make that happen. And so in my team, we have a group of what I call implementation managers. And what these people do, they continuously try to broker connections between the portfolio companies we have invested in and the businesses in Shell. And even then, it's hard work, but it happens a lot. In fact, I think 95% of all the startups we have invested in do have a contract with Shell somewhere within the organization to jointly develop technology, a supply agreement, an offtake agreement. But it's a deliberate effort that you have to put in place in order to reap the real benefits from corporate venturing, which is the strategic value. But on the other side, you do have to create the financial returns, because otherwise a new CEO comes in town, he looks at your financial performance as a venture unit, and he'll cut you short at the knees, right? So you need to do both, but the value for us really is on the strategic side.
Actually, just continuing on what you said, that value for us seems clear. However, when you are working in a corporate and you meet a startup, what I found was that a lot of the time the startups don't really understand the level of involvement that is necessary, the various working groups, the various budgets and programs that need to be arranged and formatted and made available within a corporate to make this partnership work. And I find that this is many times underestimated. Could you talk a little bit about that so that the startups can also understand really the level of your engagement that is necessary to make it happen?
Let's do ladies first.
Sure. Totally agree. Everything, Geert, that you have just mentioned. From the startup side, I'd say the effort that it is a two-party. It's a dance that has to be synchronized together. So on the one hand, being an owner of a startup program, we need to have the people and the processes in place to make sure that we systematically follow up with the portfolio companies that we have. At the same time, from a startup perspective, it's about a lot of persistence and patience sometimes. So we may need to go through 3-4 meetings in order to get to one recommendation on this is the use case, yes, that we all agree it's worth the time and effort for both parties to work on together. Because the sheer amount of people that we need to bring into the picture, no? So we have a legal process that says certain the collaboration agreements is what kind of standards and quality control that we need to put in place is if we are talking about taking solutions from a startup to our customers and so on and so forth. So from that perspective, it's a lot of learning on both sides. So it's us learning from the startup in terms of how their technology work and how can we have a combined value proposition. And on the other side, from the startup to say so looking at from a corporate perspective, is how can we jointly have a proposition to our customers that is as the expectation of our customers is at that level.
Mm-hmm. Geert?
Yeah, I think it's really important that you help the startup connect at the right level in our organization. And that really goes to the business leadership rather than try and approach every asset manager individually. And I call it the race to be second. Technology implementation is often a race to be second. Everybody admires technology, everybody loves it. But once the first big investment needs to made happen, to implement the technology, everybody in the company and the organization is looking at each other. It's like, why don't you go first so I can look at your learnings and and then I'll go second, right? So it's a race to be second. And so to break through that, you actually need to connect these startups with the executive vice presidents and VPs of the business who can take those kind of multi-asset type decisions and cut through through the crap, basically. Yeah.
Mm-hmm. And how was that experience with you, Carlos? Were you preparing before you brought on board a corporate venture, or was it more spontaneous and you were learning later on? How did this happen?
Well, for us it was very easy in the sense that we were almost born with a corporate. So the first investment was actually done by Iberdrola. Before we even had a bigger team, no? We were 3 people. So we were born with the reportings, with all the structure that is necessary to liaise with a corporate. But you mentioned that sometimes it's underestimated by the startups or SMEs how much involvement it takes to collaborate with a large corporate. That's true. But I also think that the large corporates also, you mentioned it's a dance, not synchronized. The large corporates also need to make efforts to understand how they can integrate technologies, because people who are in the ventures, you are by definition open to the exterior, not looking, scouting for things. But once you invest into a company that has a strategic value, then it goes into a different level of interaction, and you need to integrate that technologies into teams and operations that are probably not so open. And how does that work? How is the corporate open to that SMEs technologies as well? It's also a factor to be considered.
Mm-hmm. Yeah, and if I may add on to that, and that's why CVC as a program helps. So that is like when we come into the picture and try to convince the rest of the organization why we should create these special paths. Why do we have like these special cases that we can push through like the bureaucracies and try to find some efficient way in getting things done? And then, so once you have started doing it for the first, for the second, and the third time, like the company realized and learned that, like, so what kind of risk are we talking about? Like, what are really the exposure of like reducing the redundancy of some of the processes? And from there, like, we may be able to expand that to a wider range of startups, even though, like, including those that we have not invested in.
Mm-hmm.
Yeah, thanks. I'd like to add one more thing is also as a corporate, you need to look at your procurement processes and the methodologies you use to buy stuff, right? Startups don't have time to entertain a 20-page non-disclosure agreement. They don't often, I haven't got many startups in my portfolio that have a legal officer, for example, right? So we really looked at, okay, how can we slim down our purchase agreements and our non-disclosure agreements to make them more palatable to startups and scale-ups and make it easier for them to do business with us.
That's great to hear that you're making so much effort to integrate the startups into your ecosystems. But I think it would be useful to understand for the startups that are listening to you at what stages and with what they are ripe to come to you. Could you just talk a little bit about your criteria and when are the startups, in fact, ready for your partnerships?
For us, our starting point, it's what we call Series A, or maybe seed extension. What does it mean by? What do I mean by that? Is this period where you already have a working solution, and preferably 2 or 3 customers, some initial KPIs to suggest that the solution is working. The reason is because our biggest value is to be able to take you to our customers and be able to introduce you to more scaling opportunity to be able to sell more faster. And so we would like to be able to work with them right away. And so having a working product is important. So we've decided to start from that stage, but then moving onwards, it will be either through the investment program or if the company is already like quite matured, like we'll pass them through to the partnership program.
And can you just add some information about the amounts that you would be looking to invest and follow on?
Yeah, it very depends. So we start with like around like $500,000 US, euros, depending on the geography of the startup, and then all the way up depending on the topics.
Okay. And Shell?
Yeah, in our case, we just set up a new fund, a large fund that has a seed facility, has a venture facility for, say, Series A to D, E, and then we have a growth equity facility. So we can go all the way from the very start and founding of a company to the exit. And of course, the requirements differ a little bit for each of the phases, but for us, besides technology, it's a lot about the strength of the management team and their experience in scaling technologies up. In energy, anything you do needs to reach a scale in order to actually matter, right? Energy is an industry that touches our lives at so many levels, and if you can scale it to something that puts a dent in the system, then it's not of a lot of use. So that scaling capability is really important, and we'd like to see that back in the management teams. And if it's not there, then we'll try through the boards to add people to the management team that have that experience of taking it from lab and pilot scale to something bigger. I always say, maybe one last thing I want to add is it's better to invest in a great management team with a mediocre technology than the other way around, to invest in a great technology with a mediocre management team.
Absolutely. In terms of that management team and those founders, what I found is that they very much appreciate their independence. So there is always a lot of discussions about who's on the board, how much influence the board has, and how this works. And this is particularly important with corporates as a question to understand here the approach, the strategy, and the level of involvement. Could you talk a little bit about your strategy for board for your startups?
Yeah, so we are very active in the boards, and I'll tell you, I'm in several startup boards, and I'm generally disappointed with the conversations that I see in most of our portfolio companies. I don't see a lot of board members to be actually really active. We are active in a way where we really try to help these companies, but not in terms of, influencing, decision making, in terms of investing and stuff like that. And I think that corporates have a responsibility to be active, but also be a bit hands off, and let the management team do their job and support where they need help, right? Otherwise, you get this strange strangulation type relationship where the startup becomes way too dependent on the corporate, and I think that's a very unhealthy dynamic. But we train our board members through the UK Institute of Directors to be effective at that, and I think that's really important.
Yep, for us, we'll always ask for a board observer seat. So we don't necessarily need to vote, but we do want visibility because that is like part of the strategic value that we would derive from that investment. And instead of myself, I do sit on a couple of the boards of our portfolio companies. We tend to find people within our organization who has the domain expertise, who we believe can add value into the startups who are working on solving certain problems. And because of that, they can bring their long history. Some of them are really expert in a particular field, and they can take their expertise into the company and help them to solve particular problems. So because some of the times the entrepreneurs they're very good with certain technologies and they are super energetic, but they are not necessarily very deep into the domain knowledge, especially in our fields, which is airlines and hospitality. And so we try to bring in that element as well. And so in a way, rather than pure supervising the startups, it's also about sharing experiences with them as well. And once again, because we are corporations, we tend to say that I'm not the person who's going to scrutinize you every quarter on your budget and whether you have been meeting your target for the end of the year. I would rather focus on the discussion on how we can collaborate and how we can add value into the company.
And could you talk about your board dynamics,
Sure.
Carlos?
Sure. Well, in general, I would say the more trust, shared values and shared objectives you have, the less of a controlling relationship it is and the more supporting relationship it becomes. No? We have had, from the two early stage corporates that invested in AlgaEnergy, Repsol and Iberdrola, we had two people from each in the board with majority votes, quorums, etc. And as we continue developing the company and we gained the trust and we met the milestones we foreseed, etc., at some point they stepped down of the board. They say, okay, you just need to keep me informed. And that was a natural development. Now we have Yokogawa. Yokogawa is not on the board. He has a right to be, but we have a level of trust and we collaborate every month on these meetings, etc. We keep them proactively informed. They don't need to be on the board to support the company. So that's the perfect relationship, I would say. But I also think it depends on what kind of corporate it is. No? We have had the experience of partnering with a company that had synergies only at the end of the value chain, which was Repsol, only for energy. We had one that had at the beginning and at the end, which is Iberdrola, for energy at the end, and for CO2 usage at the beginning, so we can leverage the CO2 emissions to grow microalgae. That was another synergy. And then we have Yokogawa, with this right at the middle, with this technology. What I've seen is that the more to the right side, the more to the end of the value chain the partner is, the corporate is, the more controlling it becomes. Because he's more a customer than a provider. Okay, that's what we have seen.
Mm-hmm. It's interesting that you had a few corporates at the same time. Yeah. I'm just wondering about that dynamic. Is that helpful to have more corporates at the same time, do you find? Or one corporate is more easier?
It depends on the topic. It depends on what is being discussed. I mean, from a general principle, what we have done at the board level is always making decisions that are unanimous. That has been the case for us from the beginning. No? But I would say Repsol stepped out before in 2014 because we shifted towards another vertical that was not energy. Iberdrola stayed, and I would say with one you can get along better than with two, because then you have half the interests. No? Companies, although they're in the same sector, they don't have the same interests.
Mm-hmm.
Maybe if I may add something,
yes.
I think it's important that corporates, sign up to the same terms and conditions as VCs do, right? Where corporate venture capital goes wrong, and where I still see bad behavior in the market with some corporates, is where, for example, they ask for right of first refusals, right of first negotiations. They try to limit the exit. They try to get exclusivity. They try to avoid another corporate to get on board. I've seen that recently with a large utility company here in Europe. And this kind of behavior kills startups. And you've got to be really careful. And it gives the whole sector as a whole a bad reputation. So, you need to be prepared, if you want to play this game, to sign up to plain vanilla VC terms. And any strategic value that you want to create needs to be separately negotiated in separate agreements with the business directly, but not through the corporate venture unit.
100% in agreement. For us as well, we actually have a lot of co-investments with our airline customers, who also have like corporate VC funds. And we always say that we are very open to co-invest with our fellow solution providers in the industry. At the level of innovations, is when we're talking about supporting new things coming into the industry, the element of competition, it's a second thought. Notice it's more important that we prove that this is actually going to happen and is successful, and then we'll figure out how this can be scaled later on. Yeah.
Mm-hmm. So, Geert, you actually mentioned exits, and that is also always a topic. When you have a VC fund on your cap table, you kind of know they have a 10-year time horizon. They need to exit at one point. There needs to be liquidity, and they don't really have any of this strategic link. So it's a different kind of process for them. Could you talk a little bit about exits? How do you approach those from your corporate venturings?
So there's, if you are 10 or 20, even 30% of the cap table, still your level of influence to force an exit is limited. Yeah, so you got to take it when they come and have to be a bit opportunistic about it. We've had only few cases where Shell actually did buy the company and was the acquirer of the portfolio company, but in most cases we're happy for the company to be sold on to a credible new owner. Yeah. And at that time, we have probably already secured offtake agreements, collaboration agreements, and the strategic value is well on the way of being created. And so when the exit happens, what we often advise the management teams is to get a financial advisor to help them approach the market and not just focus on one country or maybe one region, but actually go broader, especially in clean tech and climate tech these days. There's a large appetite for companies that goes beyond Europe. And so really focus globally to see which exit potential is there. The vast majority does it through acquisition, so it's trade sales, but also we see increasingly IPOs and SPACs and other mechanisms being used for exits.
Yeah, it also comes back to the percentage that we actually own in the company, right? To say for us, except for a few cases, typically we keep less than 10% in the company, and because of that, what we do is we align with the entrepreneur and the other financial shareholders. To say if they believe that that's the right moment to head for an exit, we go along the way. So we are perfectly aligned, one process. And then we get out at the same time. So there has been a few cases where we exited earlier, due to various reasons. The company has pivoted, and they believe that it will be better for their growth if Amadeus is no longer on their cap table, and we respected their wish, and then we left. So separate reasons, different reasons, but we are always aligned with the wish of the entrepreneur in terms of how they would like to manage that process.
Mm-hmm. And Carlos, has exits been a topic of either negotiation as you were setting up and bringing in corporates, or later on?
Not so much. I know because, for example, the Japanese, they invest without an exit in mind. This is a completely different culture, and we are doing plans for the next 15 years, so it's completely different. And the other ones, we're investing more for a strategic reason, rather than exiting, having the technology integrated or being a customer in the future for energy, etc. So those discussions were not on the table with the corporates. They were, of course, on the table with the next investors that we have had, Caixa Bank, etc. Those are financial players, and we need to have systems that, depending on the years that pass, unlock themselves, and then we open different liquidity windows, and that's all managed from the beginning. No? But with the corporates, we didn't have that. And we found that when we pivoted towards sectors that were not of their maximum interest, imagine a board where you have Repsol and Iberdrola, and I'm talking about tomatoes and poultry and this kind of things. No? At some point you say, okay, but it's not of my interest anymore. No? So we need to look for an exit. And that's a process that needs to be led by the company, you know? Because as Geert mentioned, you don't have the influence with a 20% stake to create a situation where you can exit meeting all your objectives. No? And in particular, if the company is at an early stage, because any money that gets pumped into a company at those stages should be to grow the business, no? And not to exit a shareholder that is existing there. So I found it really difficult for corporates to exit, really difficult. Also, because, and that's another factor I want to throw in and get your opinion on this, but I have the feeling that since corporates understand better the market and also see not only a financial value but a strategic value, they tend to value higher the companies. And also they can even minimize the risk. They understand better the risk, and they can minimize the risk with the synergies. So if a company is valued by a corporate a little bit higher than by a financial player, if the next one is a financial player, what's the stepping stone? No? And that's a problem.
Yeah, I think it's important not to be too greedy, to be frank. I see that a lot, and I also see, therefore, startups fall into what I call the valuation trap, where the company, every time it raises capital, needs to show an uptick. And then at some point, 5 years down the road, the VCs have left the room because they need to raise a new fund in order to put new money in. And then the company puts itself for sale, or there's a new financing round coming. And because the valuation has already increased stratospheric levels, there's not a lot of new investors interested to invest. And the companies actually get stuck. It's a bit like a house that is on the market for too long. There's nothing wrong with the house. The price is simply too high. And as a result, I see some of these companies really struggle, and particularly in energy, where you need to be very patient, and the typical holding time for us is more than 8 years before we have an exit. So you need to really have patient capital and also not be too greedy on valuations.
Mm-hmm. Okay. We have a very concrete question from the audience. How can they reach you to send over an investment proposal? What is the best strategy for that? Maybe Suzanna, can you explain?
Sure. The most common way, it's LinkedIn. So you can find me extremely easily on LinkedIn. But I have to say, I don't respond to LinkedIn messages that much. And it's because of the sheer amount of reach outs that we have individually through that platform. And so I would say, like, among the CVC community, we always say, if you are really keen in reaching out to a CVC, find somebody who knows us. So that's the most easy. That is the easier way to get attention from us, because, say, to be honest, like, the number of proposals that we really receive, it's really too many for us to screen through. So through LinkedIn, through conferences, so try to see how you can connect to somebody who knows us. Then you will have a better chance.
So actually coming to EIC Fund could be one way to reach you.
Absolutely.
Yes, let's do a bit of marketing for the EIC Fund. No, I agree. Actually, you would be a good channel to go through. And I also agree with you. I mean, LinkedIn and email is overrated. I get 300 of them a day. There's no way I can respond to them. So find people that know somebody in my team and approach that person. And, it's part of the selection process, I guess, where, good startups will find their way to the money. I think that's the best way to approach it.
If I can give a hint to the startups, and I was discussing this with Manuel earlier today, So many, in particular, small companies, deep tech companies, tend to underestimate the importance of having a good communication, of having people doing public relations, of having a good marketing strategy, to be out there. Because in the end, if you are hiding, it doesn't matter how many people you have scouting for technologies if it's the guy in the house hiding. No? So there are many opportunities, many initiatives like EIC. I've been in several of them, in corporate events, and I can tell you this is a unique tool to do high-value matchmaking and valuable networking. And so be out there, look for the opportunities, try to find the people that we're mentioning, because if you hide, because you have a good technology, nobody's going to go to your home to get it. No? You have to show it. You have to have a good person that has skills to communicate and to network. And that can go a long way, and people tend to underestimate that.
So communication is key. Being out there is very important. Showing your product, your solution, your idea, and working with EIC is also a very good idea, it seems. That's a good recommendation. Maybe we could switch for a moment to the audience. If anyone has a question, please raise your hand up, and please free to take the mic.
No? Yeah? Yes. Hi, my name is Ricardo Maravão. I'm one of the co-founders of BTI. We work a lot with innovation with big corporates and startups. My question to you is... Hello? My question to you is, when you find these interesting technologies, interesting startups that you want to invest, how do you work with the business units to convince them that they should try out this technology? Because most of the times they have a focus on the business, and they have a focus on, they want their bonus at the end of the year, and they don't have time to work out with startups that really don't bring any business. So how do you convince the business units to actually work with the technology that you're bringing to the CVC?
So, yeah, that's the key question, of course. So we don't need the business unit to approve an investment, right? So we can make that investment decision independently from the business. I think that's really important, by the way. Otherwise, you're going to, by default, invest in late-stage technologies that are already very mature because the business needs it tomorrow, right? So that's one thing. But answering your question is, you need to involve the business very early on, already in the investment decision process. So my investment committee, and I have, for all the funds, I have separate investment committees that meet every week. I have key representation from the business in the investment committee. So you already start warming them up to, listen, this company really has something unique and differentiating to offer. And you involve them in that whole decision-making process. And then, when the investment is done, what we typically do, we have a person on the business side and on my side to face off with the startup and really work them to a level where we can start deploying their technology. In my sector, the energy sector, since we're going through the biggest transition that this sector has ever gone through, we realize that a lot of the cool and great technologies and business models will come from startups, right? So that realization is there throughout the company, that we depend more and more on startups and scale-ups to make that energy transition, which is an enormous challenge. And so that DNA of working closely with startups is definitely there. But then you need to organize it in such a way that the business actually makes time to engage with the startups. And you're right, otherwise they'll get focused and bogged down on day-to-day stuff, and they won't have the time in the day to spend with the startups.
Yeah, and on my side, I don't necessarily need business units to make investments, but at the end, if I want to deliver that strategic value, I need access to customers, and that is business unit. And so, from that perspective, I would say it's about alignment. Like, we have regular dialogues with our business units, every single one of them, so making sure that we understand where their priorities are. So it's having that agreement of like if there's one thing that we can work on together, what is that? Right? And focus on those priorities, because changing business units' priorities is not necessarily the most productive activity that I want my team to be working on. Right? So it is about finding the common priorities and be able to find the right topics that they will be willing to commit and work on together.
I can also add to that, for us, it has always been really helpful to find the ambassador within the corporate, find the godfather, no? That can tell you what is being discussed internally, who you should convince, what is the message, and that is making it much easier to tackle really the doubts, no? Because if you don't have that insights from within the corporate, it can become a really frustrating process.
Brilliant, thank you very much. Just to end this panel, thank you so much for your engagement and for being here today with us in Brussels. I'd just like to add to all the startups that are here. Everyone is really open to talk to you. Please go out and speak to Suzanna, speak to Geert, get some tips from Carlos, but also reach out to Manuel here on the front line. If you want to start building these relationships on the corporate side, please just feel free to reach out, speak to them. This is the opportunity to do it. So everyone is welcome, and EIC is really building a big, big startup community right now. So please engage and be a part of it. Thank you.